This is a Momentum Media production.
The SMSF Advisor Show. Your expert insights into the biggest themes shaping the SMSF advice industry.
Hi everyone, and thanks for joining us on the SMSF Advisor Show. I'm joined by my co-host Aaron Dunn, CEO of Smarter SMSF. Hi Aaron.
Hi Miranda, how are you?
I'm good, and yourself?
Cold. Melbourne is very cold at the moment. Yeah, it's just part and parcel of winter, but you kind of forget just how cold it actually gets.
Even Sydney's pretty bad at the moment.
So as is always the way, as we kick off our SMSF Advisor Show, we talk about what is making news and what's driving traffic on the SMSF Advisor website. So Miranda, over to you.
Right, so I think it's going to be a pretty big week for news this week. Tomorrow, our time at recording, we're awaiting the Hill versus Zuda decision, which is meant to be coming out Wednesday. So that was obviously to do with whether a BDBN can be lapsing, whether it lapses every 3 years or if it can be indefinite.
Yeah, so this is a decision where I guess we're going to get the Commonwealth law ultimately applied to this. So we have, over a period of time, had different state decisions. You know, if we think about in WA and Queensland, Victoria, we've all had challenges around the payment of superannuation death benefits and the construct and form in which nominations were valid or invalid and so forth. And I guess this case with Hill and Zuda, which was an appeal from WA from memory, is ultimately, as you said, Miranda, testing the fact that we have a 3-year review and renew function within the SIS regulations that ordinarily the law says does not apply to self-managed super funds. And therefore, we are looking to the deed in respect to both the form and substance in which that nomination must take. So, yeah, again, this is going to be a very interesting decision because it could have quite profound ramifications on the SMSF industry if, of course, they say that the 3-year review and renew process is actually applicable to SMSF. So, yes, it will be an interesting week and your fingers will be typing at a very fast rate of knots, I guess, by the time that decision gets handed down.
I'm sure we'll be putting something out about it. So, yeah, it'll be interesting to see which way that goes. Speaking of cases and decisions, we also saw the ATO put out a decision impact statement about a case that came out from the Administrative Appeals Tribunal in April. So this was to do with an SMSF and whether it was liable for GST for the sale of certain lots which were subdivided.
Yeah, so this is an interesting one. I think you said it was sort of the first time that they've looked at the interpretation of the 3 limbs that are set out within Section 188.25 of the GST Act. So what's interesting in this case is that we have land that ultimately qualified as business real property and was transferred in specie into the fund. Now, when you're undertaking those sort of transactions, there are a whole range of small business concession considerations, potentially stamp duty considerations, and then GST considerations that need to be looked at not only at the time, but what happens thereafter. And this is ultimately what was being explored here, because once those assets have been transferred into the fund, there'd then been some form of subdivision and then disposal of the lots. And then the whole outcome was based upon, the GST impact of the disposal around those and the timeframes that apply as well. So, something that if you are looking at doing in-specie transfers, in particular business real property and GST is going to form part of that, getting that transaction right, not only at the time, but what might happen thereafter. This is a good lesson and really reaffirms what the ATO had said initially. So through their interpretation, like I said, of Section 188.25.
Yeah, and obviously most SMSFs aren't registered for GST, but definitely would be something relevant for those that are.
Yeah.
The other thing that we saw was ASIC pursuing another property developer who was sort of allegedly enticing SMSFs to roll their money over into property developments. So we're still sort of seeing a bit of that happen. And at this stage, they've frozen their assets and the sort of investigation still ongoing at this stage.
Yeah, and there's probably not much more I need to add to that. They've been around a while, haven't they? So, ASIC,
there's been some comments about that already.
Yeah, and ASIC will play a very straight bat in terms of dealing with these types of arrangements.
Yes. The other thing we saw was another hike in interest rates. So it increased quite a significant amount this month. It's up 50 basis points.
Yeah, so couple of things I think are worth noting here. From super fund investors' point of view, I think there's some positives. I know many of us at home, have home loans, and we may sort of be feeling a little bit of the strain of that. But if we think about our clients, then naturally, and in particular, when you think about the fact that there may be further rate changes and so forth, and talking about the cash rate being sort of north of 2% by Christmas, it'll be interesting to see the impact that this has on the investment strategy of many of our clients, because, in many instances over the past few years, they've been chasing income and potentially some of them taking on more risks than they would otherwise have done. And with cash rates going up, I'm sure there'll be a little bit more competitiveness in cash and fixed interest rate providers as well, which may mean that we'll see some of those retirees putting a much greater focus on retention of asset rather than the growth that has been going on for the past few years. The other thing to note here is that if clients that do have LRBAs, that there was an increase in that safe harbour rate, so from 5.1 to 5.35%, I believe. So it was a quarter of a percent interest rate increase, and that will apply from the 2022-2023 year. So needing to make sure that you have adjusted for repayments as a result of that interest rate to ensure that it stays within the confines of the safe harbour in PCG 2016/5, where there is a related party loan in play.
And the other big thing that we saw was the ATO has decided to extend that transitional compliance approach that it outlined in PCG 2020/5. So that's obviously around non-arm's length income that applies to expenses where there's a general expenses. So we've seen them extend that. So obviously that follows the announcement by the coalition that they were going to look at sort of fixing the rules in this area. We haven't heard anything completely solid that Labor's going to look at this, but there has been some indication that it's on their radar as well. So the ATO has obviously decided to extend this a further year.
Yeah, so this is good news because, as you've rightly said, we saw Senator Jane Hume discuss this in April about looking at addressing the way in which Section 295/550 currently applies and how the ATO most importantly interprets that section of the law based upon the issuing of Law Companion Ruling 2021/2. So, yeah, it was finally to see some extended relief is great, and without sort of stealing some of Phil's thunder, it was a positive thing to see. And I think we're going to hear from Phil shortly, and hopefully he'll give us some insights into not only what the relief means, but I think he's been actively involved in the process to get to where we are now and then where we might get to, I guess, in the next 12 months as well. So I'm really looking forward to having a conversation with him.
Yeah, so we're going to be joined by Phil Broderick from Sladen Legal. He's the principal of Sladen Legal, and he'll be taking us through what this extension means, but also, as you mentioned, Aaron, some of the other sort of issues in the NALI space happening as well. So we're now joined by Phil. Hi, Phil. Thanks for joining us.
No worries. Thanks for having me.
So as we mentioned before, the ATO has obviously decided to extend that, I guess you could call it compliance relief with the non-arm's length income for where there's sort of expenses of a general nature. So could you just take us through kind of what that means for SMSF professionals and their clients and what that specifically applies to?
Yeah, sure. So this came about when they introduced the non-arm's length expenditure rules. And the ATO, after a long period of time, finally came out with its finalised view as set out in, what is now LCR 2021/2. And they had two types of non-arm's length expenditure that they had a view on. And it's the second one that we're interested in with this extension. And that's where the ATO took the view that there was some non-arm's length expenditure that didn't relate to a particular asset. So it relates, in their view, in the ATO's view, to all of the income of the fund as a whole. And that's where you had some potentially dire consequences, because if you had some of these non-arm's length expenditure that related to the whole of the income, not to a particular asset, then all of the income for that year would be taxed at 45%. So you could imagine not charging an expense of say $1,000 or undercharging by $1,000 non-arm's length expenditure, in the ATO's view that all of the income of the fund of that year, and let's say it was $1 million because we had a big capital gain, would be taxed at 45%. So not charging $1,000 or undercharging by $1,000, we get a tax bill in that example of $450,000. So crazy, disproportionate response. But the ATO, because of obviously putting this view out there and I guess the dire consequences and giving trustees time to respond to that, said that they would take an administrative approach. And in that administrative approach, they said that they wouldn't allocate compliance resources to determining whether those non-arm's length expenditure rules applied or not. And that's been extended now a couple of times, and under our recent announcement, it's been extended to 30 June 2023. So it doesn't mean the ATO won't apply the non-arm's length expenditure rule to non-allocated expenses, but it means that they won't actively look for it. And that basically gives trustees time to either stop doing these sort of related party dealings where there is undercharging or no charging, or to put them on commercial terms, make sure they've got the proper charge, etc., so that in the future, after this compliance approach is put in place, and assuming the law hasn't changed in the meantime, then at least they'd be good going forward.
So, Phil, the interesting thing here, I guess, is as an industry, there have been a multitude of bodies that have really got together to try and iron out ultimately what some of these challenges have been. And I know you've been right at the very forefront of this from its draft form in 2019, and I think even the pre-draft form before the legislation was finalised in 2018. We did see Senator Hume obviously make some announcements prior to the federal election, and we of course have a new government now. So the ATO quite clearly here have identified the fact that timing is of importance here to give us this further relief for 12 months. But I'm interested in, and I'm sure our audience is interested in hearing, where did we get to the point where Senator Jane Hume acknowledged that we would be able to try and redress this potential issue that we have before us at the moment?
Yeah, so it was a lot of work through that group body that you mentioned, Aaron. So that included the SMSF Association, SMSF, all the accounting bodies, ASFA, and other bodies representing both large and small funds. And look, it's the first time, certainly in my experience, that all of those groups have come together for an issue, and that does show how important it was and that it affected both large funds and small funds. And initially that group put a lot of effort into discussions with the ATO in relation to potentially reversing this view, because it's important to know there's nothing about any of this in the legislation. This is the ATO's interpretation of the legislation. But look, and we definitely got some concessions out of it, but we didn't get the full U-turn, I guess, that we were hoping for. Cool. So the next phase then of those joint bodies was to make submissions to Treasury and government. And happily, at least at that time, we got the announcement from the government, from Senator Hume, and didn't get a lot of details in that, but it was along the lines of we're going to make sure it works like it should. Now,
fit for purpose.
Fit for purpose. Now, who's, fit for purpose under the ATO's view, under the industry's view, somewhere in between, who knows?
Yeah.
So that was great. At least we were going to get some law change. And then there was the next, argy-bargy about what the law should be. Obviously, now we've had an election. We've got a new government in place. We haven't got anything, any firm, anything from the new government about where they sit in this.
Yep.
Though that joint body group is now making submissions and was previously to the opposition and now to, the current Labor government. So we're certainly hopeful that we'll get some law change. I think we're particularly hopeful that this is an issue that affects both large and small funds. And we know that the Labor government obviously has got an affinity towards the large funds, including the industry funds in particular. So we're sort of hopeful, we're hopeful, and we'll continue the battle to get this law changed so that it works properly. And in particular, proportionality. So if I go back to my example before, where we've got $1,000, either if this rule is going to apply, then if you haven't charged or undercharged by $1,000, then the NALI tax of 45% should just be on the $1,000, not on the $1 million of income. So at least that would be, a beneficial change. And then a lot of these issues drop away, because if you haven't charged appropriately, then you should pay, the penalty tax on that additional or undercharging.
Yeah, and that goes to probably the body of the rest of that ruling, doesn't it? Whereby, yes, when we're looking at expenses of a general nature, we have the practical compliance relief that is available to us, but it doesn't extend to those specific expenses. And they use some examples there with property, and I think it's an agent. It's not charging full tote odds. And the fact that the relief doesn't apply to those circumstances and haven't since this law came into effect back in July 18, I think it was.
Yeah, that's right. So that's a very important thing to remember as well, that, that concession is, as you say, only for the non-allocated expenses. If you've got any undercharging, so you don't charge the proper interest rate on an LRBA for, buying a property, that'll taint the property with NALI tax. If you do some work to the property, because, as you mentioned in that ruling, there's a few examples about, whether electricians were triggered by not charging, whether coming in and doing some minor repair works or some more extensive repair works, and the greyness between all of that and the difficulty of trying to administer all those sort of things under the current view. Yeah, that's a live issue right now, and live issue for the ATO. They're not giving any concessions around that. So you really have to go and make sure, if you do any of these related party dealings, particularly that relate to a specific asset, that protect yourself as much as possible. Make sure you get, benchmarks for the charges that are served by the related party. Have some evidence, get proper documentation, etc., so that you just put in the best position that if it is reviewed, that you've got a lot of evidence to support what you've charged.
With those transactions that aren't sort of part of the compliance relief, are there any particular areas that people tend to sort of get trapped by?
Yeah, look, if you look at the examples in the ruling, a lot of them are real estate related. So that's something particularly to be looked at, whether you're doing some, sort of related sort of repairs or something like that, whether you're, managing the property, that sort of thing. So the ATO have accepted, though, that sometimes when you're doing those things, you're actually doing them in your trustee role, and have acknowledged that Section 17A of the SIS Act says that trustees can't charge for their services. In any event, that's the job of a trustee, is to run the fund. Then you've got a bit of a, which is, it's a good, so that they won't trigger non-arm's length expenditure if you don't charge. But then you've got this grey line of what tips over into, something which you do in your trustee role, and what have you tripped over into being a service provider role. And Aaron mentioned before around the agent who was managing her own properties. So she's a registered real estate agent. She's managing the properties, but she effectively does it through her business. And then she charges, because it's a discounted fee, that taints not only all the income of that property, but potentially the capital gains as well. So, there's real issues with real estate. And I think you either, if you want to be the best protected and take a conservative view, you outsource everything. But if you're doing something internally, you either be very comfortable that it's a trustee type role, or if it's not, charge a proper fee from your related party. So that real estate, I said, that's one main area. The other one is sort of accounting type services or auditor type services, and that seems to get a lot of press. The ATO have, in their ruling, said you don't have to charge for preparing things related to the financials and the tax return, but if you do other services to the fund, that will potentially be caught. But look, when you're looking at these things, you're looking at any sort of related service part dealings with the assets of the fund or just the fund generally.
And I think I recall now, Phil, as well, that it moved into things like if policies were in place in firms, because I think the accountants and the financial advisors who are our audience here very much appeared to be kind of front and centre with that, expenses that are general in nature, because we did see accounting fees and sort of those investment fees around investment strategy and so forth. And the fact that you're using the SMSF software and there's no fee charged for that use and so forth. But that change was the fact that, if there were actual policies around that, then that is going to also go some way to helping to justify a position.
Yeah, look, when I speak to accountants about this all the time, it's the number one topic is around, getting the SMSF returns and financial statements lodged. So, and they don't charge, and they say, well, look, blah, blah, blah. But, and you're right, in the draft ruling, there was a lot of really confusing sort of statements around, well, if you did it on the work computer, then that would be triggered by this. But if you did it at home, so a lot of that stuff was pared back to some degree. Certainly in the final ruling, they've said if it relates to just doing tax returns, financial statements, it's not caught by these rules. So that's a plus for all the viewers. But if they're doing other accounting services, yes, there's also an acknowledgement that you can not charge or have a discounted fee as long as that's offered to everybody, at the firm. So it's a firm-wide staff discount. Of course, then you get the sole practitioner saying, well, what about for a staff of one? But, I think if you document it, it's probably still a staff discount. But, it does show some of the nonsense around this. But I think the fact that they've clawed out the tax returns and financial statements, I think a lot of that's probably 95% of the accounting services done for an SMSF. So other accounting services are probably in their trustee role anyway, if it's sort of an advisory, thinking type work.
Yeah, there do seem to be quite a few that were just going to charge, before the ATO sort of made that announcement, they were just going to charge the full amount to avoid the whole confusion, but I guess I won't have to worry about that for another year. Are there any other sort of elements that are still sort of uncertain at this stage?
Just that whole concept of non-allocated expenses is just very difficult and makes all of this stuff complex, and whether it's trustee director role. And that's where we're really hoping for the law change to in the best case scenario, just get rid of that concept, or at least make it proportionate. And I think a lot of that drops away. But at the moment, to protect yourself against that, and this is good for SIS Act compliance anyway, is just supporting what you're doing, getting benchmark material to back up your charges, make sure you've got, proper documentation, and whether that's something generic like, leasing out the property through your, real estate business, or doing some sort of accounting services through your accounting business, just having something to back up, what you're charging, or if you've got a staff discount, having something. So like all these things, it's getting all the documentation in order before you get a knock on the door from the ATO so that you're ready to go, and justify all these expenses that have been charged. And that they are or not charged, and as to why, they should or shouldn't be charged, and if they are charged, at what particular rate they're charged at.
Well, it's been probably the most topical topic of the past couple of years. And as I said before, Phil, you've been certainly front and centre of it, and your expertise and insight today has been hugely valuable. And no doubt as this continues to progress over the next 6 or 7 months, we'll probably get you back again and have a bit of a further conversation. So thanks again for your time.
No worries. Thanks for having me.
So Miranda, that was once again some fantastic insight from Phil into what has been very interesting and challenging topic, I guess, over the last few years. And it just goes to show that there's a lot to be worked through, and not only impacting SMSFs, but larger funds as well. So what did you take away from today's conversation with Phil?
I think it just sort of highlighted that there are a lot of grey areas with the whole NALI transactions. Obviously, you've got to work out if the trustee hat is on or if you're acting in another capacity. That throws up lots of issues. And I thought it was interesting how he sort of mentioned that lobbying sort of had to restart to a certain extent now that Labor's in place, but hopefully they do get some progress happening with that soon.
Yeah, and you would have seen, I'm sure, the fact that as a collective, I think we're seeing more and more now, aren't we, where there's a collective of associations really working together to get outcomes. So, and that imprimata's clearly come from the government, that if you're going to come at them individually, there's going to be self-views perceived throughout those submissions, whereas we've got multiple bodies coming here together through accounting professions, legal professions, SMSF, APRA fund, ASFAs and this sort of stuff, which really then says to the government, guys, we've got a problem here. Listen to us. We're saying this as a collective. And it's then that they start to say, oh, okay, we need to listen and we need to come up with something that is far more tangible in its outcome. And I think we're seeing that in some of the quality of advice stuff as well at the moment. So, I feel like even though we've got another 12 months of relief, we are probably a lot closer than we've ever been before. And the fact that we are collaborating as an industry to get the outcomes, it gives me much more confidence that we will end up in the right position than where we have been. And the, this kind of almost nonsense outcome that we get with it, the fact that, you can taint so much of the fund's income just through what would be an immaterial charge around, accounting fees or something.
Yeah, exactly. And as you sort of both said, it's not often that you get the APRA funds and SMSF and the whole sort of sector lobbying together. So hopefully there is a good outcome from that, and it can obviously it's going to impact all super funds potentially. So yeah, it'll be good to see what happens with that.
Yep. So as is always the way, Miranda, we have a variety of topics and speakers that our audience want to hear. So if they've got any suggestions, how can they get in contact with us?
So they can get in contact with us at editor@smsfadvisoronline.com.au. And yes, we'd be happy to hear any suggestions for speakers or topics.
Excellent. Well, thank you once again for being a part of the SMSF Advisor Show. We wish you a great rest of the week and we'll see you next time. Bye for now.
Interest rates are rising fast, and that means higher mortgage repayments. But some lenders have increased their rates more than others, so that could mean your clients are now paying too much for their loan. We can quickly compare your client's rate with hundreds of similar loans, so you are confident that you've got the best rate on the market, or we'll find you a better rate. Make sure your clients aren't paying the highest interest rates. Call Finny today. Visit finny.com.au and let us take the research and admin out of finding a new rate for your clients.